content of my presentations are only for education purpose only and should not be used as an investment advice. So I think before we go up there and talk about the real technical investment thingy, the important thing is to understand what is the US market at the current moment, because only by knowing what is going to happen right now, then we can know what is going forward, right? So what is US market right now? So in today's market, there's a lot of different voices. There's a lot of noises coming into different angle, and a lot of this, in fact, a lot of news are very conflicting, right? So if you don't follow the news very carefully, you will see that one good news negate with a negative news the next day, and then after that you have one positive news and negative news. So the market seems to be like very directionless. So that's basically why we need to know what is the current state of US economy right now. So I'm going to touch on with very simple macro view of what's going on in the US market. Number one, I think we have to look at it is the fiscal policy, which basically what Biden has done so far, coming to 6 months in presidency. What has he done? In conclusion, basically, Biden has made a lot of announcements. The announcements are mainly surrounded with only two topics. One is spending, the other one is taxes. All right. So so far, Biden has actually announced 1.5 trillion for government spending, 2.3 trillion for infrastructure spending, and 1.8 trillion for job plans, and not to forget 1.9 trillion of these COVID simulation plans, right? So his units now is no longer billions, it's actually trillion, and that is really a lot of money. And so far, Biden is all about spending, all right? It's all about spending. There is really nothing talk about how he's going to make money. The only thing that he talked about making money is what he has actually, preached for during his presidency is to raise the corporate tax to 28%. And that's basically what he's doing. Now, the reason why, of course, is that when you have spending, you need to have income, right? So tax is supposed to offset the spending that or rather is the main revenue, right, to support his spending. That's basically the whole idea. But the people on the ground, especially the businessmen, doesn't like it, right? Corporate doesn't like high tax, especially right now they are doing at around 18 to 21%. And then you want to increase all the way to 28. That is going to hurt their earnings at the bottom line. So which means that there is a lot of oppositions on the ground, including the not only the Republicans, but also the Democrats. His own kind of people were actually against this tax. And every time when he bring out this topic of this corporate tax, you can see that the market will do a dip, and then suddenly the few more days later, the market will sort of like bounce again. So the topic is not new, but every time it is being mentioned, you will see that the market will sort of like affected because the market really does not like the tax. Therefore, what Biden do is that in the recent G7, comprises mainly of the US and European countries, what they did is that they're talking about minimum corporate tax, 15% across the board. So now that is basically a welcoming move because now instead of just giving raise tax from the 80% to or around 21% to 28%, now everybody has to pay a minimum tax of 15%. Now, if this motions pass through, or if this is the one that's going to be right, what I would see is that it's going to be a very positive for the US market, right? Because now the corporates who are actually making a lot of money, they don't have to pay as much tax as what they use, that they will be asked to, which is a 20%. So which is good. So that is one thing that we will have to watch for, which is the tax portion, right? Trust me that at this point of time, there will be a lot of noises, a lot of different voices regarding about this minimum corporate tax of 15% and the Biden original 28%. There will be a lot of noises between the two. But as long as the inclination is towards the minimum tax, then I will see that the US market will grow from this point onward, right? And looks like it is going to be that way, because the number of people on the ground, as I mentioned earlier, has opposed the tax. That's really big. Now, the second portion I want to talk about is monetary policies. As we know that the Fed has been printing a lot of money over the last 15 or 16 months or so. Now, and originally last year, the Fed has actually set an inflation target of 2%. And that was set in August 2020. And meaning to say that the Fed will continue to print money up to the point of 2%, and then they will say, we will stop. But the thing is that the Fed does not believe what they see, and they decided to continue to print that money. And then later on, that printing process of this QE, right? Not only that the quantum is big, but it was extended to the year 2023. That was the original plan. Now, as a result of that is that from this month onward, in fact, from as early as March this year, we can see the inflation rate has actually go above 2% and then reach somewhere like 2.8, 3.2, and the last we saw is about 4.8%. And looking at the momentum, it's going to climb further. Inflation is going to climb further. Now, the Fed see it, but the Fed choose not to acknowledge it. So they are going to continue to print money. As far as the minutes and the meeting are concerned, they are continuing to print money, despite the fact that right now there are so much cash in the market. Really, they still want to print. Now, their reason is because they don't believe the real economy is improving, and they want to monitor a period of time before they start to stop this QE process. So that was the reason that they gave last month. But in the most recent meetings, Fed has actually changed their tone quite a bit. And they say that they may consider to buy back some of the bonds ETF, and sort of like reduce the amount of QE. And that has been very, very, can be seen on their M2 money supply. So what happened was that in February, you can see that the money supply was growing at the rate of close to 27%. And then it has now reduced to about 13.84% in April. So that is a big drop in terms of growth. Now, 13% is still a big amount of money that they are still printing. So don't take that the fact that 13 is like, oh, it's a number that's smaller now. No, we're still talking about our money being printed. But the whole point here is that at least now Fed is acknowledging, silently acknowledging that there may be too much money in the market. But then on the bigger scheme of things is that they are still continuing to print money, and they don't intend to stop until the year 2022. All right, this is their tone and this is their message right now. Now, so we talk about general economy as a whole. The general economy the general economy in US right now is actually improving. People get vaccinated, more people are vaccinated, and corporates are actually getting their employees back to office. In fact, there are a lot of employers are forcing their staff to go back to their offices. Really, they say no longer work from home, you guys need to be back in the office. So which is a good sign, all right? And it is a V-shaped recovery. Now, what I do have in the over the weekend is that there was a news article on Wall Street Journals. You can see that the U.S. household wealth actually increased in June. The U.S. household wealth actually increased by 13.13 trillion. All right, the whole of last year. So in other words, the COVID the pandemic situation does not really affect the US household. The US household actually has increased in wealth. And the next chart actually shows, you can see, this is the year 2020, 2019, and this is 2020. Right. So US household wealth has actually increased tremendously over the pandemic areas now. And because of this wealth that has accumulated within all these Americans, and of course with the help of the stimulation plan, Americans actually has more money in their hand today. And with the additional money that they have in hand, it actually drives the inflation up. All right. And right now, the CPI, the inflation rate, as I mentioned earlier on, is about 4.8%. 4.8% is very close to 5 already. And in fact, the market is predicting that this month they are going to go over 5%. All right, more over 5%. So, so this is the main concern right now. And because of this, we can sort of like filter this flow of thoughts down to something what we call spending or consumer spending. Now, consumer spending is a very big thing in US because that actually determines the consumer confidence level, the goods, the non-durable goods, and the services. So it's basically a measurable indicators that we will look at it, once a month. And so during last year, when people are not allowed to go out, not allowed to travel, this US consumers are mainly spending on goods, all right, goods, on non-durable goods. That's basically where they are. And the price of all these goods has actually, and this consumption has actually gone up nearly more than 70%, all right? This year, with the opening up, there is a shift from goods to services. So consumers are now spending more on services this year, right, going forward, and you will continue to spend on services at this point of time. Now, and we can see from some of the numbers, for example, the pent-up demand for retail sales, the pent-up demand for cars and electric vehicle. So these are some of the things that consumers are buying, when they have money in their pocket, and because of that, that is of this pent-up demand, right? And the manufacturer did not actually cater for this pent-up demand. Therefore, there was a sudden shortage of parts and material, right? Driving up the raw material price. So you can see a lot of the commodities price has actually shot up quite tremendously within a very short period of time. I'm talking about gold, silver, soybeans and that sort of things. And they actually drove up quite a bit going forward at that point. So what we are seeing today is not something, what we are seeing today with all these shortage, chipset shortage, and the freight charges are so high now. There is a reason behind all this, and this is due to all this pent-up demand, and the demand is real. All right, it's not something you can speculate or, it is already been written in the statistics books already. Now, the second one to look at it is the employment rate. Now, employment rate in US right now is actually, the unemployment rate right now is actually quite low, right? It's about 5 to 6% only. The number of non-farm payroll, which is the indicator that I will look at it every month, is fall below the expectations. So what we are saying is that we are expecting more people get employed, right? But the numbers come in is that the number of people get employed is actually lower last month. So the number was actually disappointed. And we think that the market may be not doing well because of that, because there's no job for everybody. Wrong. On the other hand, is the number of vacancies actually rise to nearly 9.3 million jobs available. Nobody wants to take up. Nobody's going to take up. So it actually says some things like is that now people got money, they want to enjoy, they've been trapped in the house, they want to spend it, they don't want to work. So you will see news like McDonald's trying to raise a per hour rate to up to $15 per hour or something like that. And nobody want to take up the jobs. And that is where it is right now. So, so this is also another indication that the US economy is improving. Then finally, we have this food and energy. Food price has already go up, all right, and that's external factors because of China. But energy price go up. It also means that people, the demand for the activities for this old fuel, the oil has come back, right? People are start to drive long distance travel, tourism, that sort of thing, industrial applications. So the oil price has actually gone up. In fact, it's actually gone up to more than $70 per barrel. So which is also one of the indicators to show that the US economy, the real economy is improving. So finally, we go back to what we interested most after knowing all these things, right? So what does all these things tell us? All these things tell us that only in conclusion, the economy is improving. People has more money, they want to spend, and all is looking good. Okay, so now we go back to equity. Now, equity is that the beginning of the year. Now looking back, look back at history. The beginning of 2021, the tech stocks were really flying. Come to late February, it has a deep dive, and then it has been staying low for like almost 2 months, 2.5 months, and not be able to move tech stocks. But where does the money goes to? The money actually goes to the broad market. In other words, you go back to the real economy, whereby you look at companies like Coca-Cola, McDonald's, Starbucks, Walmart, Dollar Generals, that sort of thing. It's basically a broad market spread out. And then, of course, it goes back to some of the industrial stocks, such as Caterpillar. These are the infrastructure type of stocks, cement, oil, or industrial related kind of things. So this basically is what we call broaden now. So instead of just focusing only on tech stocks, money actually goes back to all these general broad spectrums stocks. And it has been going well for almost 2 months. And then now, as of 2 weeks ago, market start to shift again, all right? The recovery stocks are now sort of like, the momentum does sort of slow down, and then it moved back to tech stocks again over the last 2 weeks. So again, the opportunity that we see is that growth stocks is still the area, all right? When the broad market has sort of like come back to their valuations or go further up, then people will start to say that, okay, now it's overvalued now, let's look at something which we can grow our wealth. And that's where the growth stocks is going to come back again in the coming weeks. That's how I look at it. Okay, so basically this is a very quick rundown on the US market, or rather the US economy as a whole, a very brief overview. So now we look at something which is what the main topic that we are in today. So this is a S&P 500 PE ratio, historical, from 1950s all the way to 2020. This is the zero line, represent the benchmark. Then I have 1 standard deviation, 2 standard deviation. This is -1, this is -2. Now, how you read this table, this chart, is that the moment when it cross +2 standard deviation, it means terrible overvalue, all right? and then +1 is considered as overvalue. Anything between 0 to 50, between this 0 to this orange line, right, is the price, or rather is the value that we want to buy. All right, that's basically the general rule of thumbs. Now, as you can see that right now, S&P 500 is already above +2 SD. Okay. Now, as much as I personally hate to deny that the US market is overvalued, because deep in my heart I say no, it's not overvalued. But statistics don't lie. So on this chart itself, it does shows that S&P 500 is now more than 2 SD, and it is overvalued. It is basically what it is showing right now.